Hello to everyone. Today I am here with Introduction to Business Finance, Financial Statement as Part 4. These are the academic videos. If you are interested to have updated academic videos on banking and finance related topics, please do subscribe my channel. In this session, we are going to cover the financial statements that are of three types. First of all, balance sheet. In balance sheet, on one side, we have asset, and on the other side, we have liabilities plus equity. Assets are equal to liabilities and equity. Thereafter, we have income statement. Income statement reflect on one side revenues and on the other side expenses and taxes. The net of revenue and expenses and taxes reflect us the net income available to the business. Thereafter, we have statement of cash flows. Cash flows are of three types: operating cash flows, investing cash flows, and financing cash flows. Now, in this session, we are going to cover all these. Here we have the financial, we have balance sheet. First of all, we have current assets that include cash, account receivable, inventory, short-term investment, etc. Thereafter, we have long-term assets that include gross fixed assets, less depreciation, that will give us the net fixed assets position, long-term investment, etc. So the total asset should be equal to total liabilities plus total equity. Now, on the other side, we have liabilities plus equity. Current liabilities that include accounts payable, notes payable, accruals, short-term debt. And we have long-term debt. The sum of current liabilities and non-current liabilities equal to total liabilities. Thereafter, we have common stocks, retained earnings. That is a part of equity. Equity also includes reserves, treasury stocks, etc. The sum of total liabilities and total equities should be equal to total assets. You can simply compare for both years. Thereafter, we have income statement. Income statement, first of all, we have sale, thereafter cost of goods sold. The difference between the sales and cost of goods sold gives us gross profit. Thereafter, admin expenses or operating expenses. Thereafter, we have earning before interest, tax, depreciation, and amortization. Thereafter, we have depreciation and amortization figure. The difference of earning before interest, tax, depreciation, and amortization, and depreciation and amortization is earning before interest and tax, EBIT. Thereafter, we have interest expense. Sometimes it is also called as financial charges. So the difference is earning before tax. Thereafter, we calculate the tax at the rate of 40%. That can vary from country to country. So thereafter, we have the figure that is net income available to the business. Now, statement of retained earning. Retained earning is the part that is reinvested within the business. Balance as on June 30th, 2022 was 275,200. That is a part of our equity side. We add net income to this business, that is 773,358, and less the dividend paid 706,269. We will have the balance as on 30th June 2023, 2289. You can verify it from here. Here you can see the opening balance, the closing balance for 2022 and the closing balance for 2023. Now, if the dividend paid figure is not provided to you, so you can calculate by previous year retained earning balance plus net income balance for the current year and the current year minus current year retained earning balance. So you can get the figure of dividend paid as well if it's not provided you. Now it's a data. Number of shares are 100,000. Par value per share is 6.6. You can also have a look at the common stocks. Common stocks are 660,000 and number of shares are 100,000. If you subtract 660,000 with 100,000, you will get the par value that is 6.6 per share. Thereafter, we have earning per share EPS. Net income is divided by number of shares. It comes 7.73 for 2023 and 5.77 for 2022. DPS is dividend per share paid. We have the figure for the dividend and we have divided by the number of shares. It comes 7.06 for 2023 and 6.25 2022. Thereafter, we will calculate the book value. Book value is equal to equity divided by number of shares. Equity for 2023 is 1,02,289, that is divided by 100,000 for 2023 and 935.20 for 2022. Now, why book value is important? You compare the book value with the market value. Sometimes you are paying the premium. Sometimes you are purchasing the stock at discount. When you purchase the stock on premium, when there is a good news about the company, like they are going to purchase a new technology equipment, it's a good news. So you may have to pay the premium. On the other side, you find a very good venture with a foreign company. You find a very good order, export order. So these types of the news force the investors to pay premium. When discount, you purchase when you have a bad news, like your company may lose certain type of the orders. You have management problem. So these types of the news decrease your market value from its book value. Now, in case of analytical trends, the people work for these types of the practices. Other types of the market are trend market. They used to follow the trend without having any analysis. In the trend markets, you will find more bubbles. Means many time it happens, the stocks used to be traded on high premium. That is by all means unjustified and create the bubbles within the market, and bubble can burst anytime. Here we have the balance sheet variance between the variables. Now here you should have the clarity which type of the variables are interest bearing and which type of the variables are non-interest bearing. Cash is non-interest bearing instrument. Variable account receivable is non-interest bearing. So on the other side, inventories are non-interest bearing. Short-term investments Yes, they are interest bearing. Gross assets, they are non-interest bearing. Long-term investment is interest bearing. On the other side, accounts payables are non-interest bearing, notes payables are interest bearing, accruals are non-interest bearing, short-term debts are interest bearing, long-term debts are interest bearing. So you should have the clarity which variable is interest bearing and which variable is non-interest bearing. Here we are going to develop the cash flow statement. First of all, operating activities. We have three types of the activities: operating, financing, and investing. First of all, we have the net income for the year 2023. Depreciation, we will take the depreciation that is reflecting in your income statement, not of balance sheet. So you will add back because depreciation is non-cash expense. Other sources, increase or decrease in accounts payable. Here we have the increase, that's why increase is positive. Increase and decrease in accruals. Here we have the decrease, so decrease is reflect in negative in the accrual. Now what are the uses? Decrease in account receivable. Now here we have the increase, that's why we have considered it as negative. Again, increase in inventory, that's why it's reflecting in negative. So the net cash flows provided by operating activity is 610,832. If it is positive, the company is having the rich cash flow. And the company didn't need any financing from any source, provided they are a different plan, for example, capacity enhancement. So in that case, they may require the financing. Otherwise, company seems to have a rich operating cash flow. By time it happens, the company shows the good health as a part of its income and balance sheet part, but operating cash flows reflecting the negative cash flow. So that can be a sensitive point. In that case, you will have to go for the in-depth analysis. Investing activity. Now, decrease or increase in the financial asset. Here we have the increase in the financial asset. It means the financial assets are added to the assets. They enhance their financial asset. Here you will have to think or check either the financial assets are revenue generating or non-revenue generating. If they are revenue generating, the company will definitely enhance its incremental cash flow. If they are non-revenue generating, it will add only the expenditure. So you will have to analyze. Financing activity. There is no increase or decrease in the short-term investment. Yes, there is increase in long-term investment. That's why it's negative. Notes payables are increased. That's why positive. Short-term debt is increased. Long-term debt is increased. And we have the dividend paid. It's a part of financing activity. So the net cash flow provided by the financing activity is equal to that. Now the net change in cash from operating, investing, and financing activity, we will have the net change in the cash. And cash at the beginning of the year and cash at the end of the year. So if these figures are up to mark, it means you have developed your cash flow statement in an appropriate way. Now you can vary these figures from your balance sheet. Here you can see the cash difference 186,473. Okay. And the cash balance for the year 2023 is 118,950. If these figures match, so your cash flow statements are correct. If these figures do not match, it means there is some error in your cash flow statement. Now you can check it. The figures are similar. It means there is no error. The figures you have developed are up to mark. Here we have developed the summary. First of all, operating activity net income plus depreciation, net cash provided by the operating activity, net cash provided by the investing activity, net cash provided by the financing activity. Their net change in the cash is calculated if you add all the figures, from here, from 94195 and 9552 minus 286402, their sum will be equal to minus 186470, and you will add the beginning cash at the beginning of the year. That will be the closing bank for the previous year, that is 305420. The ending cash will be equal to 118950. So you can verify it. Now, comment on the financial condition from a statement of cash flow. Net cash from the operating activity is 610832 positive, mainly because of the good profit earned by the company. The firm borrowed the long-term financing to meet the capital expenditure. We have seen the borrowing is against the long-term expenditure. That is the addition to your fixed asset, and borrow short-term financing to meet the production cash requirement. So normally short-term financing is only to meet their production needs, running finance, or any seasonal financing requirement for a short-term period. So if the company having rich cash flows and they are availing the borrowing from the other sources, it can also become a question. So you will have to inquire it. Although the company generates handsome profit and paid dividend to the shareholders is more than 100%. Now it may be they might have the borrowed because they have certain commitment to the shareholders to pay handsome dividend. It can be a reason as well. Although the company having the ability to meet their financial obligation based on its health. Thank you very much. See you again with the upcoming video on the same topic very soon.